Hey everybody, welcome back. Mynor Ramos here along with Mike Domico. We've been covering the 8 banking principles, and today we're going to talk about a concept that the banks use very, very well, and that's float and leverage. Now, think about you just went shopping. By the way, a pet peeve of mine. Every time I go to, any department store, what's the first thing they ask you? Do you want to save 10% by applying for credit today?
Yeah.
Right? You know what I ask them every single time? What's the interest rate? Don't know,
Yeah.
right?
Yeah.
Again, I'm kind of messing with an hourly employee. It's really bad of me to do that. But you know what? I want to elevate their thinking, right? Because you know what ends up happening is they don't understand that $20 or $30 that the individual may have saved, it's costing them 27% interest rate, right?
You understand why they don't understand it?
I don't
They're
understand
too
it.
worried about how to pay their own credit card.
That's right. But let's just say that they already have the card. They have $500 into this account, and you pay your Visa bill in full at the end of each month. You just floated the interest like we talked about in the last video. Now, leverage is your lender's money interest free anywhere between 25 and 30 days, depending on when the credit card provider was able to do that. But here's what it is now you're banking smart because banks understand and use the concept of no stagnant money. Just like this little pond that I saw the other day, and I guess the filter broke and there was no movement there. So all of a sudden, like, starts to stink a little bit, right? Like, I mean, it's because they're stagnant. So think about the banks understand no stagnant money. The money has to be circulating. Now, smart investors do what banks do. They know how to move the right amount of money at just the right amount of time from what account to what account. Remember, we were talking about, you owe $500 on this one, and it's charging the 27%, but you have another credit card that isn't charging you anything. Just move that money. You just got to know where. But most people don't understand their numbers. We did talk in a video, we talked about the 4 major numbers you need to understand, and that is all the income that you have, all your expenses, all of your debt, and then all of your cash flow. How do you think you're going to manage your cash flow if you don't bank the way that the bankers do it? Now the bankers will let that money sit at the right length of time before they move it into another one. Now, there's a little bit of velocity banking, a little bit of infinite banking, right? Because you can't really do infinite banking until you understand at least the concept of velocity banking. And I'm always interested in just the banks have this concept of, they'll take somebody's money. So they have sweep accounts, right? So every day at the close of business, the banks will sweep the checking and savings accounts of all of their clients. So we're talking about billions of dollars, right? Now, do you understand why at the end of the day of the business day here in the United States, where that money goes? Well, it goes overseas. It goes to Europe. It goes to the Asian markets. What are they doing? They're making that money move, right? For 12 hours. They have the ability to make that money move. They go trade, do whatever they need to do. And then around 8, 9 o'clock the next day, the money comes back into this. So they're just sweeping the money, right? Banks use our money to earn interest for themselves while you and I are sleeping. Here's what they know. You might want to write this down. Banks know that their money works 24 hours a day, 7 days a week, 365 days a year. So the thing that you must do to be a banker is you must think like a banker, you must learn like a banker, and insurance is one way to do that. Now, why am I so passionate about this? Because we talk about legacy, and a lot of times what you don't know can hurt you. But you know what? Sometimes the people get to hear it, and for some reason they don't buy into it. And so I always ask this question. When I used to take my little kids to the bank with me, they would offer the kids what? A lollipop. Why? Why did they do that? I mean, the audacity to make money on your money, make interest on your money while you're sleeping, and then give you a lollipop to call you a sucker.
Well, I hate to inform you, but you're a bigger sucker than that. Until 1968, banks were able to take out money from the Social Security fund, the trust fund, at no interest. So we've been sucking the wrong end of that stick for a long time.
Wow. I did not know that.
Yeah, well, that's what happens when you're around too long.
Well, that's crazy. Well, listen, guys, I know that there are some of you that are just really enjoying, our free education. All the information that we have is, between the two of us, over 80 years of like combined experience. But when we bring in, Josh Collier, the younger guys, over 100 years of total experience into these, the banking principles and the insurance principles. So this has been another episode of Advanced Insurance Strategies covering the 8 banking principles. Stay tuned for the next one.
Thank you, Mynor.
Thank you.